Alright, so today we're talking about the new crypto law that was just signed as part of the $1.2 trillion infrastructure bill, which is a huge victory for President Joe Biden. I'm not going to bore you with the details, I'm sure you've seen what's in this bill, but in a nutshell, it focuses on improving transportation systems. That means building new roads, new bridges, giving access to clean water, renewable energy, focusing on improving high-speed internet, focusing on jobs. It's things that America desperately needs. But underneath that, there are three main problems that President Joe Biden is trying to fix. And the first problem is inflation. If you haven't seen this number, the CPI, the Consumer Price Index for last month in October came in at 6.2%, which blew everyone away. That's insanely high. That is the highest we've seen since August of 1991. In the last 30 years, we've had the most amount of inflation we've ever seen. This is crazy. The second problem that he's trying to fix, of course, is supply chain issues, because we are making stuff, but we're not shipping it. It's just stuck at the ports. And so the idea is, if we focus on improving that infrastructure, hopefully we can ship that stuff, because as of right now, if you're not shipping that stuff, if you combine that with high demand, then you have a lot of people competing for the same limited amount of stuff, which drives the price up, hence inflation. And the third thing he's trying to improve, of course, is labor shortage. Because if we get more people back to work, then hopefully there's more competition, which should drive prices to go lower. But in today's video, I want to focus on the crypto aspect of things and how it affects investors, specifically crypto investors, because full disclosure, I invest in a lot of crypto, so it's mostly a PSA to me because it's going to affect me a lot. Let's just get right into it. Hi, my name is Andrei Jikh. Hope you're doing well, come for the finance, and stay for the transitory video. You know, if inflation goes away by the year 3021, technically Jerome Powell could say, see, I told you inflation wasn't permanent, I just never defined how long transitory really meant. But inflation is higher than we expected. Let me just quickly share with you some of these numbers, because this is the reason why cryptos like Bitcoin and Ethereum have been skyrocketing in value recently. It's because inflation is crazier than we thought. From October 2020 to October 2021, here's how much prices have gone up. Shelter is up 3.5%, and this is a big one because it represents 32.5% of the entire weight of that score. There's also food like meat, chicken, eggs, fish. That is up 11.9%. We also have utilities like our electricity, which is up 6.5%. Our gas bills are up 28.1%. New cars are 9.8% more expensive. Used cars are up 26.4%. Rental cars, crazy, 39.1%. We're not done, because insurance on those cars is up 6.3%. Maintenance on those cars up 5.4%. Gas for those cars is up 49.6%. And then restaurant food is up 5.3%. Hotels are up 25.5%. The point is, everything is getting more expensive across the board. I know we talk about inflation all the time, and it's hard to really understand these numbers unless you put them in some sort of a context. And I was talking to a friend the other day, and I put it like this. Imagine you had $1,000 saved in your bank account. Even though the value of that $1,000 didn't change, like the number didn't fluctuate, it's still $1,000, the amount of stuff that it buys you today is significantly less. For example, if you were to spend that $1,000 today, you would buy $900 worth of new car today versus last year, or $880 worth of food, or $750 worth of hotel nights, or $736 worth of used car, or only $500 worth of gas. When you put it in that kind of a perspective, it becomes very upsetting to realize that even though you worked hard to save your money, today it's worth that much less in only 1 year. This is why you need to start investing instead of keeping your money in the bank. And as more people wake up to realize this, they'll also start investing, which is why the price of assets will continue to grow and get higher until we're forced to slow that growth rate down by increasing interest rates. But with all that out of the way, if you did start investing your money, especially into crypto, let's talk about how this infrastructure bill will actually affect you. There's two interesting clauses inside of this bill that's about to make things a little bit more complicated for us. And the first provision is SEC 8603, information reporting for brokers and digital assets. Now, this basically redefines and expands the definition of what it means to be a broker. In the traditional sense, a broker is a company like Coinbase, for example. Whenever we buy our assets, Bitcoin, Ethereum, Dogecoin, whatever it might be, from Coinbase, we are buying directly from Coinbase. In other words, Coinbase is the one selling us those assets at whatever price Coinbase decides to set them to. This is in comparison to an exchange, someone like Coinbase Pro, which matches buyers with sellers. So if I'm buying my Bitcoin on Coinbase Pro, the reason it's cheaper is because I'm buying directly from another seller instead of from another company that's facilitating the trade. For example, Robinhood, whenever we buy stocks and crypto on Robinhood, that's considered a broker. We are buying it directly from Robinhood. Robinhood is not matching us to another seller. It's very important to understand the difference between these two because it's about to change. So let me just tell you what this is. It's a little wordy and complicated, and then I'll break it down. It defines a broker as any person who, for consideration, is responsible for regularly providing any service effectuating transfers of digital assets on behalf of another person. A lot of complicated words to unpack here, but what this means is that if you're somebody who is transferring digital assets on the blockchain, which includes cryptocurrencies, it includes NFTs, tokens of any kind, anything that's on the blockchain, you are legally required to report every one of those transactions because you would be classified as a broker. The problem with this, though, is that it's such a broad definition that includes literally everyone that's participating in crypto, including people that are potentially investing, people that are staking, validating, nodes, hardware developers, business people, pretty much everyone and anyone, even though they might not be knowingly transferring those digital assets because that's part of how the blockchain works. Well, Andrei, I'm not a node, a miner, or a validator. I'm not a hardware developer. I just buy Bitcoin and I invest. This is not going to affect me. That's not necessarily true either, and it could potentially affect you as well, and here's how. Let's imagine you have two wallets, one on a decentralized exchange and another wallet with Coinbase. Let's imagine you wanted to buy some Ethereum, but you didn't want to buy it with Coinbase, you wanted to buy it with a decentralized exchange because you can buy some there, you could stake it, you could earn some more Ethereum, and when you're happy, you might want to sell it and convert it back to the dollar. So you might want to transfer it back to Coinbase and then sell it, in which case Coinbase would be required to send you Form 1099-B, which shows you the profit from the sale. The problem is, this is where it gets complicated, is that Coinbase has no way of knowing what your cost basis is. In other words, it has no idea what price you bought your Ethereum at and how many Ethereums you earned off of some decentralized exchange because that exchange might not be regulated, it might not send data to the IRS, and Coinbase would have no way of knowing how much money you spent when you initially invested into it, which means you would have a profit that is potentially much larger than what you actually made. A workaround or a potential solution to this problem is to make sure that you keep a meticulous track record of all of your cost basis. In other words, everything you earned from crypto to tokens to NFTs, whether it was free or not, you have to make sure you know what price you got in at. This is one of the biggest reasons why I personally keep all of my crypto on centralized exchanges, because I know they're regulated, and by law, they are required to send me a report at the end of the year, which shows me a breakdown of my cost basis, what I earned, which I can then take and give to my accountant so they can calculate my taxes for me. Otherwise, doing this stuff on decentralized exchanges becomes a logistical nightmare that I have to prove to the IRS how much money I actually made. That is not a game I want to play. The second provision that changed is something called 6050I. Law 6050I states that anyone who receives $10,000 or more needs to report that income to the IRS and let them know that person's social security number and mailing address. By definition of this law, if we do not comply, that is considered a federal offense. This means everything that's on the blockchain, from crypto, tokens, NFTs, you name it. This means that the crypto world is about to see a lot of transfers of 9,999. Before we get into the conspiracy theories of why the government is doing this, the reason's really simple. It's because they want people to pay their fair share in taxes, which should include stocks, real estate, and crypto as well, because they estimate that they could raise something like $28 billion doing this, and ultimately that's a good thing. People, and especially brokers like Coinbase, should pay their taxes. The real problem, though, is liability. A lot of people who use crypto value their privacy, and if we go to buy our Tesla with crypto, Elon, come on, man, please. Then we are giving up that much more information because Tesla would require us to give up our social security number and our mailing address. And there's nothing wrong with that, but that makes our data that much more vulnerable if that company gets compromised. Like Robinhood, for example, which recently had its data leaked. It just sent me an email telling me that my name was exposed, but imagine if they had my social security number and my mailing address. Wait, they already do. Other than that though, the bill got majority support from both political parties, so let me just quickly give you the numbers and then I'll tell you what this means for inflation going forward. So $550 billion of the $1.2 trillion is going towards new spending, which includes $110 for roads and bridges. That's part of fixing the supply chain stuff. This is good. $66 for railroads, again, supply chains and transportation. $65 for broadband. $55 for water infrastructure. $47 for cybersecurity and climate change, awesome. $39 for public transport, $25 for airports, $21 for the environment, $17 for ports, again, supply chains, $11 for safety, $8 for Western water infrastructure, $7.5 for electric vehicle charging stations, and another $7.5 for electric school buses. I wish I wanted an electric school bus when I was a kid. A lot of this bill is basically focused on expanding the economy and helping us reduce friction and the supply chain problems so that we can hopefully drive the prices lower. In the short term though, economists are saying that this will increase inflation, but hopefully it won't be as bad and that it'll be transitory. The argument against this bill is to say, look, we've seen so much inflation this year. I mean, last month in October alone, we've seen the most inflation we've ever seen in the last 30 years. So even though this bill means well, perhaps we should be careful not to do it for next year in 2022, because there's no guarantee that inflation doesn't go higher. And even if we increase it by just a tiny bit, it could still influence people's perceptions and make things that much worse, because if you flood the economy with even more money, this could create more demand. And we can't meet that demand because we have supply chain issues and labor shortage, which creates inflationary pressures, which means prices will go up. The counter-argument against that argument is to say, this is true, inflation though shouldn't increase that much, demand shouldn't go up much higher, and over the long term, this should ease inflationary pressures. Personally, I could see both sides of the argument. I could see how flooding the economy could potentially create more demand, which is not what we want when we can't meet that demand, because that's how things become more expensive. But on the flip side, I can also see the argument that improving our infrastructure is very important in increasing our economic capacity and alleviating those inflationary pressures, even if in the short term, it's gonna increase inflation just a little bit, because in the future, we might not ever get the chance to do this again. So I could see both sides. As far as inflation goes though, we won't know for sure what it's gonna look like until at least the middle of 2022, about July, when the Fed has stopped tapering, at which point then we'll know, and based on things so far, it's probably gonna be higher than we expect. I'm just crossing my fingers that Evergrande doesn't affect our supply chain problems, because if Evergrande goes down, which is a huge real estate giant, then that could choke China's supply chains. And because everything is made in China, we wouldn't want China's supply chains to get even worse, because that will make it worse for us back home, which of course contributes significantly to that inflation. So that's two sides of the argument, pros and cons, but I'd love to hear your thoughts. As always, don't forget to have a wonderful day, smash that like button, subscribe if you haven't already. Go get up to $250 worth of free Bitcoin at this BlockFi link right here, blockfi.com/Andrei. Go get your 2 free stocks with Webull, and once you've done that, go track them automatically with a spreadsheet linked down below in my Patreon. Love you, thank you so much for watching this video. I'll see you back here on Monday, Friday, sometimes Wednesday. I'll see you soon, bye-bye.